I made $24,000 in a single trade trading this very simple SMC trading strategy. In today's video, I'm going to break down everything included in this strategy, so by the end, you can walk away with this model and trade it for yourself. In the first part of this video, I'm going to take you through this whiteboard and break everything down so you understand it perfectly. And then we're going to go over to the live market and show you an exact trade example trading this exact strategy. So what you're seeing now on the board is the actual model itself. You can see there are just 3 steps. We just need bias, a point of interest, and lower time frame confirmation. And this is how simple this model actually looks. So the first thing we need to understand, step 1, is bias. That's it. We just need to understand the highest level of success is going to be predicated on our ability to understand which direction the market is going to trade in this session. So for me personally, I trade 2 3-hour-long sessions per day. I trade my London window, which is 2 a.m. to 5 a.m. Eastern Standard Time. And then I trade my New York window, which is from 7 a.m. to 10 a.m. Eastern Standard Time. And my job is to understand what's the bias for these sessions. Are we going to trade higher or are we going to trade lower? And the way I do that is simple market structure. So at all times in the market, price will be delivering in some kind of trending direction. If you see a price delivery like this, essentially you can understand we have a low here, we have a high, then we have a higher low. This low right here is higher than the previous low. Then we have a high that gets broken. So this is our break of structure. If you get a break of structure to the upside, then you know that we're bullish. And so already at this moment, this bullish structure would indicate to me that we're going to trade higher. Therefore, I want to get involved in long positions. When we make a higher high in here like this, that's essentially our confirmation. Price pulls back as always, and then we essentially put in again another higher low, followed by another break of structure in here, followed by another pullback. So let's say this is the picture of what's actually happening in the market at that moment in time. My only objective for this one specific session is to try to find the low of this move so that I can get involved on the upside move. Because as you can see, every time price puts in a new high, it's followed by lower prices back usually into this old price leg, and then followed by a continuation higher. And so that's all I want to do. When we find a new high, price will likely start trading back down. I need to identify an area of price, a point of interest, an area where I can trade from, and then I need to wait in here for confirmation, and then I need to buy in this level if I get my confirmation, and I simply just need to target this high. That is essentially the premise of the system. However, usually market structure doesn't look as clean as what you're seeing it as right now. So let's go and dive into what usual market structure looks like. So how market structure usually delivers is something more along the lines of this. It doesn't look as pretty and as simple as we just explained in the previous segment, but the same principles actually follow. You see, the objective is simply just to find the high and the low that is currently in control of the market and which direction that they're trading in. So usually you have a low that you need to find and the high. That's your starting point. From that moment forward, it's about, do we break below that low or do we break above that high? If we break above the high, then we are bullish. And so you can see in this scenario, we do break that high. So we have a higher low followed by a higher high. Now, what we have to understand is this is our trading range, right? So from these lows down here to this high up here, right? Before price breaks out of anything, that's our trading range. And price is going to trade inside of this range. And if we are bullish, like we are in this example, the expectation of price is to trade higher. But at first, it's actually going to try to find this low point. And so essentially anything between this high and this low is internal market structure. The problem that many traders face is that they try to trade this structure, thinking that this is the structure they should trade. And so they come in and they see that price starts trading lower like this, and they try to trade this price action in here. But this price action isn't actually your structure. This is your internal structure. What you need to see is a confirmation that we find a low using the internal structure. So you can see from when price finds the high, we start trading lower, which is always expected, and we put in a low, a lower high, a lower low, a lower high, and then a lower low. So the internal structure is bearish, but many traders fail to understand that this doesn't mean that price is going to trade lower, not through this low. This is just a pullback of a much larger trend to the upside. And so when you see this, that's your confirmation. When you go from bearish internal back to bullish internal, That's your confirmation that the probability is that now we're going to go and attack this high. And you can see that's what we do. We end up actually breaking structure to the upside up here. And we break structure, and then we find this high before price again starts to reverse with this internal structure. At that point in time, market structure is trending from the swing low down here, as you can see. Why? Because this is the lowest point that price reached before breaking out of the previous trend's consolidation. Once we break out of that high, our new high becomes the highest point of price before we reverse, and our new low becomes the lowest point in price before we break above the high. That then gives us our new trading range. So we're bullish still, but now we're bullish from this low to this high. And again, the job of us is to understand that as price starts pulling back, it will be bearish internally. We don't care about trading these internal ranges. We need to wait until we get the confirmation that price shifts bullish internally. And then once you have this, the probability is that now we go and attack on this high in here. And so if you have this, essentially your next move, if you was trading this market, would be to wait for a pullback, right? And again, the big mistake that a lot of traders make is they use this as their structure. And so when price breaks below this low in here, that doesn't mean anything for me. For me, that's just a liquidation of old lows. But for many traders, they see that as a bearish break, and now they're trying to sell from this level. And the reality is what happens is this becomes liquidity as well, and price comes into an area of interest that I'm waiting for price to come back in, give me this in here, so you can see that we're internally bearish, and then we shift. This here is that reversal. This is that confirmation. We're expecting that price will take out this high in here. Once we get this break of structure, change of character, now I can enter the market at this low here with a buy limit. When price comes in, I'll be tagged in, and my expectation is for price to just continue in that overall trend. And so you can see that it actually looks complicated, but if you strip it all back, it's very simple. From a swing perspective, we have swing low, swing high, swing low. We break structure, we reverse from this high, so this is our swing high. We come back in here, we break out to the high, so the lowest point is our swing low, followed by our swing high. Price pulls back, makes this low before we break the high. That becomes our swing low, that's our swing high. As long as we respect this level, we want to buy above this level, and we want to target the weak structure, because the probability indicates that price will trade higher in an uptrend. Of course, at some point, you may get a market reversal, but the probability of that playing out is slimmer than a continuation. That's why when you see price action in a bullish trend, you can see that before price usually reverses, there's usually 1, 2, 3, 4, 4 plus, 3 plus, 5 plus in some cases, continuations. So you can see in a bullish move, there are usually anywhere between kind of 4 and 6 bullish price legs, versus when we reverse, it's just one of them. And so the probability that price will trade higher is higher. Now moving on to step 2 is all about areas or points of interest. What that means very simply is an area of price that we are looking to get involved in. It's not enough to know that price is going to trade higher. It's not enough to know that price is going to trade lower in a bearish market. Because what a lot of traders make the mistake of doing is, let's say we have a bullish market like this, and price is trading higher. The problem is that so many traders will try to trade this breakout here. So when we break this high here in a bullish market, let's say price comes back like this, and then it goes, well, there are buyers waiting at this high. Because when that high gets broken, they want to trade the continuation up here. And that's how essentially they want to try to make money. The problem is on this pullback here, there are so many people trying to trade this breakout, right? Because directionally they're correct. And so when price comes up, they try to buy at this level. They're trying to buy from here, but then they have to put their stop losses down here if they want to logically make sense. So they have to put their stop losses here, their buys here, and now their risk to reward is going to be restricted. Because the likelihood is that price isn't going to trade all the way up here without first having a pullback. And if it does, it doesn't happen consistently. So their results become inconsistent. That's the problem with breakout traders. The difference, for me, is I want to wait for price to come back into lower prices, because after every break, there's usually a pullback. Every break has a pullback. Every break has a pullback. And our job unlike many traders, is they want to buy up in here. I want to buy the lows. They want to buy up in here. I want to buy the lows because my risk to reward is far higher. And the most important part, I have a target. When you have breakout traders that trade this direction, they try to buy after we break these highs, where are they now looking to take their profits? There's no specific area of price that there is a probability that it will trade to that level. Versus when you try to buy these lows in here, you can just target the next high because you know that we're in a trend. And so that high is very likely to be traded through. But when you're already above that high trying to trade, you don't really have anywhere to target. And so that becomes a problem from a risk to reward perspective. There are many traders out there who may have a 50% win rate, right? They may take 10 trades and win 5 of them. Their problem is that when they win one trade, they might only win 0.7 times their risk, or maybe 1 times their risk, right? That's a problem because if you have a 50% win rate, meaning that if you take 10 trades and you win 5, and on every trade you win, you take 1%, right? So you take 5%. And every trade you lose, you also lose 5%. Well, even though you win half of your trades, you're still a break-even trader. For me, that math just doesn't really make sense. So when you're trading this model, when you're catching the lows of price, what that enables you to do is increase your risk to reward. So for me, I have a 1 to 5 risk to reward, meaning for every 1% that I lose on a losing trade, I'll lose 1%. But for every 1% I risk on a winning trade, I will actually win 5%. And that will give me 5%. So if let's say for example, I have a 40% win rate, which I do, for every 10 trades that I take, 6 of them will be losers. So I will lose 6%. But the 4 that are winners end up making me 20% because it's 4 winners, but every winner has 5%. So I end up winning 20%. So if you do the math, I win 20, I lose 6, I'm left with a net profit of 14%. So it's not always about how many trades you win. It's about your risk to reward relative to your win rate. So to tie all of that back into points of interest, this is where things get interesting. We have to actually identify in the previous price leg where we can get involved. So if market is bullish like this, right? Well, when we break structure, now we need to understand anywhere between this low and as price starts coming back, where the current price is, we need to understand where to get involved in the market. And some of you have already heard about fair value gaps or order blocks, but I need to make you understand what they actually are and how to understand them beyond just pattern recognition. So usually, pretty simply put, an order block is where you have one bearish candle like this, followed by a bullish candle in a bullish example like this, and then maybe you have another bullish candle that also creates a fair value gap. So an order block in this example is going to be this bearish level, right? So you have this area here, that is going to be an order block. And then the expectation is that when price comes into this level will hold. But why? Why would price just hold on a random specific candle, right? What's so relevant and important about that order block? That is what we need to understand. Because not all order blocks work. If you're someone who's already tried order blocks or fair value gaps, and you're still trying them right now, but for some reason your order blocks just don't hold up, it's because you don't understand the context of the order block. That is a very, very important thing. So here's my understanding. Essentially, the market is always moving from a range-bound price delivery to a expansive range price delivery, back into usually some kind of range expansive price delivery, back into expansive, back into range, back into expansive, and then maybe you get a reaccumulation. These areas of price, right, what they are is they are accumulations. So accumulation, and again, many people really don't understand what an accumulation is. An accumulation is an area of price where there is a lot of volume, but it's being traded equally. Meaning that if you have an order book, right, which is what the market actually looks like, if there's an order book in here, that means for all of the sellers that are stepping into the market, there is a relative amount of buyers. And so that's why the price, it doesn't matter if there is a large amount of volume being traded in this area, price still can't go up. People have the misconception that when you see these massive moves like this, that equals a lot of volume coming into the market. That's not necessarily true. The reality is that could just be an imbalance between supply and demand, meaning that let's say, for example, you have a range-bound price in here, and let's say, for example, there was, $100 billion transacted in this price range. $100 billion gets transacted in this price range, and price doesn't move aggressively up or move aggressively down. That's because those $100 billion that were being traded are relatively being traded at the same levels, causing price not to have these large spike moves, because there is probably $55 billion worth of buyers and $45 billion worth of sellers. And so price kind of just stagnates in this area. That is what an accumulation actually really is. Another thing that people misunderstand is in these moves, they think that, this move must have way more money than a move like this. Again, that's not actually the reality. There could still be $100 billion that is delivered in this huge price leg. And yet this move here was 100 pips, and this range totaled around 25 pips. But there's the same amount of money traded. Why? It's called imbalance. It means that the $100 billion that was traded, let's say, maybe 85 to 90% of it was for one side of the market. So that's why price aggressively traded higher, because every time a buyer wanted to step in, it needs a seller, right? Every buyer needs a seller. Every seller needs a buyer to facilitate the transaction. If there's a market full of buyers and there isn't many sellers, then price will have to keep trading higher until it finds more sellers willing to sell at that price to those buyers for them to buy that price point. And so that's why, you get these range and expansion, but people think that in the expansion phase, when price trades aggressively higher, that means that there's a huge market participant just stepped in. And it doesn't actually always work like that. So you have accumulation. Now, what is an accumulation beyond what we just explained it? An accumulation is an area of price where smart money position, right? Okay, why? Well, when price is in this consolidation range, that enables them to put in a lot of money and get a better average price. So let's say there's an institutional interest, let's say a trader from JP Morgan, and that trader is tasked with filling, let's say, $100 million worth of euros to dollars, right? For whatever purpose that is. Well, his job isn't necessarily to make money. His job is to get that $100 million into the market at, let's say, 10001. That's his task. And so if that's his goal, which a lot of the times it is, he's not looking to just put all those $100 million in the market. Let's say price right now is at 10000. If he puts that $100 million into the market at this price point, there might not be enough sellers at that price level to give him the trade that he needs. And so if he did that, maybe he would get 10 million of it at this price, and then the next price, and next price, next price, next price, next price, until after the entire $100 million has been positioned, his average order value may have been 10004. And he's missed his target and he's lost the company money because this price that they quoted is the quote that they gave to another institution that they can fill that order at that price point. When you see these consolidation ranges, that's a perfect area for someone to position themselves. This is a very, very important point. And so all of the sellers, and they break up their positions, so all of the sellers that are stepping into the market, every time someone sells and price trades lower, that individual who has that job just buys enough to keep it stable. So $10 million worth of sell orders comes into the market and he just buys that $10 million. And then price goes like this, and then another person comes in and sells and he just accumulates it. It goes away, more sellers, and he just accumulates it. And so price can't seem to trade through this level because every time it comes back to this price point, that same trader is just buying the rest of his position into the market. That is why it's called an accumulation, because it's an area of price where a large institution or trader is looking to accumulate a position, right? And so after, usually what happens after an accumulation is you have these large expansive moves to the upside. Why? Very simple, because when there's a large side of demand on the market, they want to take price higher, right? They're putting in buy orders. Well, when you get into this range like this, what happens is all of the sellers that are trying to sell price lower at this level, eventually at some point in time, they become exhausted. And so they're selling, and price isn't going lower. Eventually, the longer time price spends in this level, the less sellers there will be present because they've already taken their positions. And at some point in time, sellers go through something called exhaustion. And that is essentially when the sellers from the order book, right, the sell side of the order book, the sellers becomes thin. And in that moment, there are far less sellers than there are buyers. And when there is more of one side of the market than the other, price trades higher. And so that's the difference, right? The accumulation phase is the area of price where the large institutions see as a perfect opportunity to fill an order. The expansion phase is usually an imbalance between supply and demand. There was far more buyers in a bullish example than there were sellers, not in terms of people, and purely in terms of contracts or lots or whatever it may be. And so that's why you have these large expansion levels, right? And then essentially what happens, now this becomes a quote unquote point of interest, right? It becomes an order block because this range that you see, right? When you see this range like this, and then you see the aggressive bullish move on the upside, right? And in fact, that bullish up move usually looks like this. What's happening on a lower time frame, if you take this and then let's say, for example, that this here is a 15-minute time frame, right? If you look at this price action and you go to the 4-hour time frame, on the 4-hour time frame, it's going to look like this. This range in here, right, is usually just going to be one slim candle like this. And then this bullish movement out of that area is usually going to look something like this, right? And that is what becomes your order block. This exact range in here becomes your order block on the 15-minute time frame, and on the 4-hour time frame, it looks like this. And so that's all it is. And so these are the areas that we want to get involved in price. If price is moving in an uptrend, if price is bullish like it is in here, we want to look at where positions were accumulated in that area, and then we want to trade from that level. So as you can see in here, we have a swing low, right? If we look at structure, we have low down here to high to low. We go higher high up here. Price starts reversing. This is now our higher high. Now that we are bullish, we want to look at the area where we see this accumulation of price come and get retested. And a lot of the times it comes to get retested because of imbalance, which many of you know as fair value gap. A fair value gap, or sometimes known as imbalance, simply means that an area of price where there was an imbalance. It's that simple. And I've just explained how that happens. When you see these large price moves to the upside, that is because there is an imbalance. That is because there is far more activity from one side of the market. So in this example here, there is far more buying than there is selling. And so price has to go into discovery. It has to go to new levels to find sellers willing to sell the price. And so what happens and why it's imbalanced is, number one, it's imbalanced because there was far more buyers than sellers. The second thing, because price is moving so aggressively, there's going to be a lot of unfilled orders from buyers in this level, right? Because there's only so many orders that can be transacted. And let's say, for example, there are, a group of buyers who want to buy at the price of 10004, right, which is where we are right now, and then all of a sudden huge moves start coming to the market, right? And then there's another group that want to buy at 10005, but there's only so much supply. There's only so many sellers. And so a lot of traders, when they try to put their orders in at these levels, there's no one there to transact. And so what you have is you have an area of price where there's a lot of unfilled orders, a lot of people that didn't get their orders filled because there wasn't enough liquidity available. That's why price oftentimes comes back into these imbalance areas. It comes back to rebalance price, to offer the opportunity for those same market participants to enter their positions. That is the entire process. And the purpose of that is because the market wants to be efficient. The market's job is to fill orders, point blank, period. That is how market makers and things like this, institutions, brokers, that's how they make money. They make money when liquidity gets triggered. So what we want to understand is, where was there imbalance? Where are these accumulation points? And then wait. Because whilst many traders are trying to buy here, we want to wait because we understand that price is likely to come back. And then this area here, that's our area of interest. because that's the accumulation point where the large institution purchased last time. And then you have the imbalance of price in here. So what we're expecting and understanding is that when price comes back to this point of interest, these same market participants, right, may want to, number one, protect their positions, right? So when price is starting to come back and you've got buyers in here, they may want to protect their positions. So by not allowing price to go below this low, they will protect that position. The second thing is they may want to add to their position, because let's say you have these areas of price, and let's say that person needed to fulfill $100 million of orders, and what it was actually able to fill was $50 million of orders. Well, when price comes back into this level, it's able to start rebuilding that same position, and maybe they get an additional amount of their position filled at that level. And what that looks like is when price comes into here, is you start to see that same type of accumulation, which actually takes me directly into step number 3. And so step number 3 is all about confirmation from that area. And that confirmation, because again, we don't want to just buy off of the hopes that price trades higher. We want to buy with confirmation. And what I'm about to share with you now is exactly how you understand confirmation. So when you have these moves, let's say we're bullish, right? We're bullish like this. And if you look at this area of price in a lower time frame, there's going to be, let's say, some kind of order block, right? So price comes down in here, which you can quite clearly see. There's a sell candle there on a lower time frame, and then you have really aggressive bullish candle like this, right? That becomes your order block, like so, which is just what we discovered. Inside of here, there's going to be that accumulation and expansion. Then when price comes back down, obviously we're bullish. When price comes back into this level, right? Again, what we want to see now from this level is confirmation. We don't want to just buy from this level and hope that it holds. The way to get a higher win rate and higher risk reward is when you get in here, go to a lower time frame and wait. Wait for the market to show you that this area is of interest. Don't just assume and hope. Make the market prove. It's like going to the casino, playing a game of blackjack. But the difference is you get to wait before you bet money to see what the dealer's hand is. You have an unfair advantage. And so when price comes into this level, we just wait. And we wait to see how the auction plays out. Because what will happen is on the way back down, sellers are in control of the market. But when we enter this area of interest, our theory is that maybe those buyers that were interested in buying price at this level before may want to either protect their position or add to their position. Here's the thing though, we don't need to guess. We can just wait for them to prove it. How? Well, when price is coming down here on a lower time frame, it's going to be bearish. It's going to be putting in lower lows like this. And at some point in time, what will happen is you'll start to kind of have some level of consolidation. This consolidation now is the battle. This is the battle between buyers and sellers, because you have the previous buyers who are at this level holding price up, and you have the present moment sellers who are trying to trade price lower or fill their orders. And so what happens when you get to that level is you start seeing price slow down. Price goes on its way to that level is very aggressive. And then when it gets there, it starts slowing down, because now we're entering into an area where there is a lot of activity. There are a lot of buyers and a lot of sellers. And the key here is to look at market structure again. You can see here that when price comes down, it puts in a low, a lower high, a lower low, a lower high, a lower low, right? And then price might start consolidating in here. This is ultimately the battle. And what you want to see is you want to see the same thing we've seen before. You want to see exhaustion from sellers. So when price gets in here, you want to see that price keeps trying to trade lower and fails, tries to trade lower and fails, tries to trade lower and fails, tries and fails. What this tells you is that this area is being protected right now, right? It's being held up. And every time sellers try to push price lower, they can't seem to push price lower. And at some point in time, what happens? Sellers become exhausted, right? There is less sellers at this price level because they've already filled their orders. And so you just wait for one side of the market to flip. And when you get this lower time frame confirmation here, where price is on the way back down inside of your point of interest, and then it slowly starts to put in these small structure points, and then you get some battle, and then you get the move up, and you change character, that's your confirmation. Now you can trade this move. Now you've confirmed that this is probably the area of price that price will respect, and now we're expecting to trade higher. And so you can trade from this level, buy in that level, and you can look at targeting the last previous structural high, because that's the natural directional evolution of price. That is the 3 steps in theory. Now let's go to the market and let's show this in a live trade example, step by step. So this right now, what you're seeing on screen, is the actual trade taken using this exact model in my New York session. So what I'll do is I'll take this back before the trade and show you everything step by step as to how we came to this conclusion and why in fact I was able to take this long. So here we are, just as my New York session is about to begin. And I need to be on the 15-minute time frame to understand my intraday bias. I use the 15-minute time frame structure to tell me what direction that this session specifically is likely to trade into. So as you can quite obviously see, we are in a bullish trend. And essentially, we don't need to look at all the intricate details. We can just understand that we broke this high up here. That obviously confirmed the bullish trend. We broke this high again, right, above here. And so again, if we kind of go into the structural details, in fact, I'll give you the actual structure. My swing low was here, swing high here, lower low, so we became bearish, swing high, swing low, and then we go higher high. So now we're bullish from this low to this high. Then you can see the next day price come back in here and then continue trading higher, which is expected. And we break this high. That's our break of structure to the upside. So we're bullish. And so that pretty much brings me into the day that we had, right? We broke structure, and my London session, this is how price is. We are bullish from this swing low down here up until here. And then London goes and puts in this high and then has a pullback, right? It meets my criteria of a structural pullback. See, price goes high, pulls back lower, and then trades higher again. And so the structure changes. Now we go from this swing high to this swing low to new swing high. And you can see here that this is a break of structure to the upside, break of structure. So we're bullish, and my structural range is simple. My swing low is here. The lowest point that price comes from the high to break the high. My swing high is here, where price begins to reverse from, right? Very much quite obvious. So there we already have my directional bias. I'm coming into New York session and I'm expecting higher prices because the market is bullish. And I'm expecting that price is not going to break below this low, and eventually it's going to trade up into this high. That's it. That's step number 1. That's my bias for the session. Now I need to find my area of interest. And you can see here, what does price do? Price is going from this model. It's going, after it puts in the high, it comes down here and it begins to range. And so price looks like this. We're bullish like this. And then we come in here and we put in this range in here, which is my accumulation. And then we get an aggressive move to the upside. That is how things look. We're bullish, we come back. This entire area of price here is a range. And then we get the expansion. So we get the accumulation, and then we get the expansion. And so I'm really interested in this entire area, but I can refine it. And I can refine it by understanding that this low here was liquidated. So what a lot of times you'll see is in these areas, right, when you're having these ranges, and then just before price goes higher, you'll see a sweep of the lows. That's because there'll be a lot of sell liquidity that enters the market on the sweep of those lows. If there's an interest in an institution or institutions or people wanting to trade higher, smart money want to buy, they'll first manipulate lows, right? Engineered liquidity. They'll manipulate the lows like this because they understand that there is going to be the final area of sellers in here. So when all of these sellers come in, and that liquidity coming in the form of sell stops, all of that sell liquidity goes to the market and they can have the final accumulation of that order. And then you have the aggressive price move that breaks structure. So I'm interested in this area as a whole, but I can refine my area into the area where price manipulated. And then I can understand and just use this entire area. We also have the fair value gap, right? Fair value gap simply being a 3-candle pattern between candle 1 and candle 3 that doesn't meet. That's a fair value gap. And so I can basically refine it to the final area like this. So we have the final sell to buy plus the liquidation. So I want to make sure I keep in this low. Now that is very simply my area of interest, right? It's actually very simple. You just have to understand the context as to why this happens, because so many people will look at order blocks. Now they'll see that we've just created a nice bearish fair value gap and it's inverted fair value gap. And there's a really nice supply zone above the high, but they don't understand context, right? Like Why would you want to sell from this level? They don't understand it. And that's why you need to understand the deeper intricacies of price action. That's why 98% of SMC traders fail, is because they don't understand context. They just understand pattern recognition, order block, liquidity, supply and demand, all of this jargon, and they don't know how to put it all together, and therefore they're not successful because it's not about the concepts, it's about your context. So what I want to see as approaching this level is price come into my area like this. And then I want to go down to a lower time frame because now I want to see a battle take place between supply and demand. And then at some point, I want to see a shift. I want to see price come into this level. I want to see the battle take place between supply and demand. And then I want to see demand come out on top by breaking out of the highs on a lower time frame. And then I want to simply buy from that level. Then I want to look at longing from this level. I can put my stops in here now, and I can just target this high. That's the trade model. And so you can quite clearly see that as the New York session opens, right, there's my New York open window, I'm waiting. A lot of traders are already buying above here. Doesn't make sense. Makes no sense. You need to wait for confirmation. When price gets in here, now I go down to my lower time frame. So I go down to my 1 minute time frame and look at what you're seeing straight away, right? Price is aggressively coming down, but the moment that it gets here, it stops and it starts ranging. That simply means in a New York session as well, at 8 a.m., there's a lot of volume in the market. But no matter who's trying to sell, they can't seem to get through this price level. And so now the battle is taking place. And here's the thing, right? I don't know for sure that this level is going to hold. There are occasions where this exact thing will happen, and then you'll have the range, and then price will just trade down. The key difference is I won't be involved in the markets. I won't lose any money. That's why we wait for the confirmation. Because it's the confirmation, it's what happens when you're in that area of price that tells you everything you need to know. I don't need to jump in the market if it's not ready. And so you can see here, price is just literally in this range phase, and there's a battle taking place. I don't know who's going to win, right? Again, we're still really inside of this range. We haven't seen any major break of a high or break of a low, right? We've had a little bit of breakout. We're still ranging in this area. This is all still range-bound price delivery. And then we get that. Now we have a break of the low down here, right? We have a run of this low. We're still inside the range. But now at least I know that if we break above this high that just put in this new low, if we break above that, that is my confirmation that I can execute this trade. And so it's just a waiting game. I don't need to do anything, right? This is all one big battle between supply and demand, but one of them are going to come out on top. And eventually we break the high, right? We break that high toward the buy side. Now I have confirmation, because what we've seen here is the same thing. We've had our first range of price where we can't break higher, can't break lower. We're just stuck in this level. We have our second range, can't break higher, can't break lower. Then we start breaking down lower. At this point, it's fine for me. I'm not in any long positions. If price trades all the way down lower, nothing happens to me. I just don't get in the market. But then when you break the low and then you go and break the high, now it's confirmed, because now you're seeing the buyers are now in control, right? No one was in control really. No one was in control really. Sellers started to take control. Buyers step back in, protect this area, and come out on top. No sellers could push price lower. And so when you get that, that's my confirmation. And what I do is I look at this area and now I need to find the order block. And so the reality is this entire area is really the range phase, but I need to refine it to an area that makes sense. And so you can see price sells off here. We have this final battle before the aggressive move. We have this range expansion, right? Range expansion. So that, if I go on a, let's say 5 minute time frame, which for my order blocks I usually do, that's what you're going to see. You're going to see how that actually looks like a quote unquote order block, right? That's our area of interest. Well, now you can quite clearly see that same model. You have the final sell here. We have a fair value gap, but we also want to make sure we're covering this low down here because that's the liquidation. Now you can see it very clearly. We range, no one can really take control, and then boom, it becomes evident and clear that buyers have control in this market. Now it's my time to move. And I might miss this, and sometimes I do, but that's fine. That's the price of being willing to wait, because patience is the game that wins. And so that's essentially my entry. I want to see the retest of this same level, and then I want to see protect this low, and I want to just target the high in here. Because logically, right, price is aggressively bullish. We should take this high. That's what probability indicates. And if we're going to take it, it's going to be from this level. And now I've confirmed that. And so now I get involved here and I look at getting out here. And that gives me a 1 to 6.4 risk to reward. And that's all I need to trade. That's all I need to wait for. And then you can see price eventually tags me in at this level, pretty much to perfection, this old retested level, and then has an aggressive expansion higher. That's exactly what I want to see. At this point, I could look at also moving my stop loss to break even. And so if it comes all